Today I want to talk about premium audits for general liability, workers' compensation, and some other policy forms. What they are, why they're important, and how to avoid pitfalls and problems. Coming right up. Hi, I'm Coyle, and before I jump into policy audits, can I ask you to do me a favor and hit that like button? That'll help signal to YouTube that this is good content, and it'll help my channel grow. Thanks. Okay, on to audits. Most general liability policies, including some BOP or business owners policies, as well as all workers' comp policies, are written on what is called an auditable basis. That means that at the end of the policy term, the insurance company will collect data on payroll, sales, or whatever the rating basis is for that policy, and compare that to what was stated as the estimated exposure when the policy was started. Let's take workers' comp as an example. Whether you're renewing an existing policy or starting one off from scratch, the policy is rated on the amount of payroll for each given class code on the policy. So let's say you started the policy with clerical office payroll estimated at $100,000 and outside sales payroll to be $80,000. For the policy term, you paid premiums based on these exposures. And shortly after the policy expired and is renewed, the insurance company will either ask for payroll records to be sent to them, or they will come and do a physical audit of your books and records. In New York, insurance companies must physically inspect books at least once every 3 years on workers' compensation. The purpose of the audit is to determine the actual exposures and compare them to the estimates used at the beginning of the policy year. Continuing with the example above, you report that the actual clerical payroll is $150,000 and outside sales payroll was $200,000. The company grew, hired more workers, and had more payroll. The insurance company now bills you for the premium based on those actual payroll exposures, less what has already been paid in the prior term, resulting in an additional premium. If payrolls are less, then the insured would receive a return or a premium credit. So, why are audits necessary? For any form of insurance that's auditable and starts off with estimates like workers' comp or liability, the reason for audits is that the premiums you pay are predicted on rates times the rating exposure. As I mentioned, payroll, sales, or some other exposure characteristic. The audit is necessary for the insurer to collect the accurate sum of premium reflective to the actual exposures of the insured company. Put another way, let's take the same example and say that the actual company payrolls were $1 million for clerical and $800,000 for outside sales. The company had 10 times the amount of payroll than originally anticipated, which means theoretically they could have had 10 times the potential amount of workers' comp claims. Therefore, the insurance company needs that extra premium so that the system works fairly for all of the insureds or customers of that insurance company. Not collecting that extra premium means that the insured paid 1/10 the amount they should have. And if everyone did that, it would really bankrupt the insurance company because rates are actuarially based upon the actual rating exposures. Now, what happens if you refuse to pay the audit? Occasionally, we'll have a client that did grow very significantly during the policy year, and they'll get a huge bill from their insurance company, and they'll say, hey, I can't afford to pay that, or I just refuse to pay that amount. This, of course, is a problem. The insurance company entered into the policy contract in good faith to provide insurance based on certain estimates, and they believe they are due the additional premium reflected in the audit. So they will pursue that premium in an unrelenting manner. Now, if that audit is incorrect, which sometimes happens, or the audit is based on an estimate, which I'm going to discuss in a minute, you've got a valid dispute. But disputes need to be made within 20 days of the original billing of the audit. If you wait a few months to dispute an audit, you're going to have a tough time changing the insurance company's mind. It can happen, but it's not easy. So let's talk about estimated audits. Sometimes when an insured does not comply with an audit request or they totally ignore the insurer's request for payroll or sales data, the insurance company will issue what is known as an estimated audit. Often that audit will be 2 times the policy's original premium. It's shocking, and it's meant to get your attention. The State Insurance Fund in New York is famous for doing this. and they will not back down until they get the info they're looking for. Moral to the story, when you get a request for audit information, comply and provide it to your insurance company as soon as you can. Another moral to the story is that if your company is going through some rapid growth during a policy, it makes sense to inform your broker that you'd like to adjust payroll and sales to reflect new anticipated figures based on your growth. This gives you the remaining policy term to pay that additional premium, usually in installments, rather than getting hit with just one lump sum premium payment at the end of the audit. I know this was a bit lengthy, but I hope it's helpful. If you have other questions on premium audits or workers' comp or general liability or any other business insurance issue, give me a call. My contact info is coming up, and there's actually a link to my calendar in the description box below where you can book a call right on my calendar. Thanks.